All right, my market heroes, we're back. Um, this is going to be a really fun one. How are stocks priced? Very, very interesting. So, stocks, obviously, their prices fluctuate all day, every day, not only from 9:30 a.m. Eastern Time on Monday, till the end of the trading day on the week, but also after hours, before hours. Futures markets are open almost 24/7. So, every prices are constantly moving all the time, all day, every day. But how do we arrive at like a certain price? How do we arrive at a certain fair value for a company? Um, it's very, very interesting how it's actually done and how we can use it to help us make money in the stock market and become market heroes. So let me ask you a question. Apple, right? The most owned stock in the world, not only by hedge funds and institutions, but also by individual investors, moms and pops, kids, whatever you want to call it, IRAs, 401ks, all that stuff. The most amount of people own Apple more than any other stock in the world, which includes Google, Netflix, all that stuff. It's Apple. And the question I have for you today is, will Apple go higher? Now, a lot of people will go, Stephen, of course Apple's going higher. They have $250 billion in cash. I heard the new iPhones are going to be amazing. I heard maybe they're getting into cars. Like it's Apple. Like, I have an iPad and an Apple TV and an iPhone and I'm watching this on a Mac. So like, of course Apple's going higher. But how do you actually know that? Like, how do you actually know that? And I'm not trying to just like be up against you on this, but while I understand that Apple has a lot of positives for it, how do you know that is going to reflect in a stock price? How do you actually know that? Like, how do you know that the fact that Apple might come out with a new phone is going to make it go higher? Like, how do you actually know that? And the reality is, stocks are priced off of two things and two things only, which is like kind of the cool thing here. They're only priced off of two things. So the first thing they're priced off of is something called forward earnings. So every single quarter, every public company comes out and gives their earnings, right? So their earnings for the previous quarter as well as their outlook for the next quarter and the next year, right? Investors, institutions, all these people who are thinking about buying or selling stock, let's just use Apple as an example, will come up with how much money they think Apple will make in the future. They'll take that number that they think Apple will make in the future, and they'll consider all the expenses that Apple has for R&D, share buyback, debt. They'll do all this stuff, and they'll try to predict the forward earnings so that whatever those forward earnings are, they can give some multiple to what they're currently earning now and attach it to the stock price based off of how many shares are outstanding and the market cap. So that's all that stuff. So that's the first thing that stocks are priced off of. And the second thing that stocks are priced off of is the risk-free rate of return. So the risk-free rate of return is the most amount of money that you can make with absolutely zero risk. Let me repeat that. The risk-free rate of return is the most amount of money you can make with absolutely zero risk. Now, a lot of people are like, "Oh, is it a bond?" No, it's not a bond because bonds can default. Is it what's in like my savings account? Well, not really because anything over 250,000 is not FDIC insured. The most amount of money you can make with zero risk, it's what is known as a treasury, right? As a T-bill. And right now, that's the most amount of money you can make with zero risk is close to nothing. So what happens is the market, the overall market over time, typically it takes about a year for the full risk-free rate of return to get added and compounded to stock prices. But the market collectively will pay you to invest and risk your money to the tune of the risk-free rate of return that you normally would have gotten for taking zero risk. So remember, putting your money in a T-bill is known as a zero risk investment strategy. Right now, you can get close to zero for that, as you can see in this chart right here. You can get close to zero for that. However, the market says, you know what? if you're going to take the risk, if you're going to put your hard-earned money to risk, we're going to give you a little kicker for that. So we're going to give you what you would have gotten if you didn't take any risk at all in the form of an investment. So again, we look at this chart, we're looking back at the 1980s when the risk-free rate of return was up 15, 16, 17%. What that meant was that number was added over the course of a year to stocks to pay people for taking the actual risk, right? So let's like actually really think about these logically right now. Stocks are priced off of these two things. The first thing they're priced off of are forward earnings. Now tell me, because I don't know, but I need someone to tell me how you could actually predict that. How can you actually predict how a stock is going to do in the future? So many things change from a day to day. We have management issues at companies. We have manufacturing and supply chain issues. We have geopolitical issues. We have the Federal Reserve raising rates or reducing rates. We have currency manipulation or all this other stuff going on. We have high frequency trading involved in a lot of actual just pure equities. So we have a lot of things. Because those things happen, stocks are constantly repriced. They're constantly repriced all day, every day, because something is happening. Something is happening all day, every single day, that is changing the forward earnings in many different investors' minds for a stock. So forward earnings is not calculated the exact same way depending on who the investor is. I might attempt to calculate forward earnings differently than, let's say, a quant might, or let's say a high frequency trader, or let's say a value long-term investor. All of us are trying to figure out these forward earnings, but we can't. We all do it completely separately. So that's why there's so many different opinions on stocks all day, every day, because everyone's taking in all this news, all these other external factors, and continuously all day, every day, repricing these stocks because they think their forward earnings are always changing because of all these other external factors. So my argument is, because there are all these external factors, high frequency traders, institutional investors, geopolitical issues, all this stuff, that you actually cannot predict forward earnings whatsoever. That's my argument. Because so much changes all day, every day, it is virtually impossible to actually predict forward earnings. We could think, if we're going back to the example of Apple, that the iPhone 8 is going to be the greatest thing ever. But if they're shipping the product from China over to the United States to sell, what happens if that shipment is a few days late? Right? Everything goes kaput. Or what happens if the shipment gets there on time, but then there's some geopolitical issue that causes people to sell their stock holdings in Apple for whatever the reason. So I am under the belief, and again, I've been doing this for a very, very long time, guys. I am under the belief, and I feel very, very strongly, that you cannot predict forward earnings. Too much can happen at a given second where predicting forward earnings is virtually impossible. So we started off this slide by saying stocks are priced off of two things. The first of that is forward earnings. Forward earnings is something that you cannot predict. So to me, stocks are not priced off of forward earnings because, again, you can't predict that. And then remember, we talked about number two, how the risk-free rate of return is added on to equity prices over the course of a year to pay people for taking the risk of investing their money. And the payment that people get in the form of the price of the stocks going up is the same amount of money they would have gotten, or the most amount of money they would have gotten for taking zero risk. So if we look at this chart right now, we're pretty much looking at the risk-free rate of return over time and this Fed funds rate in orange. So if we look back again to about 1982-ish, we're looking at a Fed funds rate of somewhere like 18%. What that meant was, back then, and this has always been around, the equities were given an additional 18% padding for that year, because that's how much money you would have made with no risk. So if you put your money in one of these no risk products, you would have made 18% a year. So in order to incentivize people, and most people don't know about this, but in order to incentivize market participation, the market over time pays you for taking that risk in the form of that risk-free rate of return. But if you see towards the bottom right of this chart, what has happened since the Federal Reserve has gotten just really, really crazy with jamming these interest rates down very, very low is that the risk-free rate of return, again, looked at by this orange line, is very close to zero. So right now in 2016, 17, 18, and probably for at least the next 5 or 10 years, the risk-free rate of return is going to be very, very close to zero. So what that means is if you put your money in a risk-free product, you're going to make close to zero. So that means that risk-free rate of return that's added onto equity prices over the course of a year for taking the risk of investing as opposed to keeping it in a risk-free account is close to zero. So now it's getting a little bit interesting. Again, we started this slide by saying stocks are priced off of two things. So the first thing they're priced off of is forward earnings. My argument is you cannot predict forward earnings, so stocks cannot be priced off of it. Everything that happens changes the forward earnings and the estimated outlooks of a stock, how much they're going to make, how much their debt is, how many employees they're going to have, all that stuff. And that changes all day, every day. So you can't actually add that into a factor when you're thinking about pricing a stock. So we can almost, in effect, get rid of the concept of forward earnings. The second thing that stocks are priced off of is the risk-free rate of return. And the truth is, right now, the risk-free rate of return is very close to zero. So what that means is there's almost a 0% cushion being added onto stocks throughout the course of a year. So now we're in a very interesting spot, aren't we? We're in a very interesting spot. We're in 1982, stocks had an 18% cushion because that was a risk-free rate of return. Right now in 2016, 17, 18, and then a little bit beyond, the market has a very close to zero cushion. So if you can't predict forward earnings and you cannot add any value into the stock in terms of risk-free rate of return, well, what the hell does that give us? What are we left with? And I mentioned this earlier. I'm going to mention it now in the next video. We're really going to get into it. But these price movements are completely random. They're like that coin flip, that 50-50 coin flip. Buying stocks outright is just like that 50-50 coin flip. Why would you do that? In what world, in what scenario would you put money to work on a 50-50 shot? Remember, stocks are priced off of two things. Forward earnings is the first one. We cannot predict forward earnings because too many things can happen at the drop of a dime that will completely change that. The second thing stocks are priced off is the risk-free rate of return. Until interest rates go up, the risk-free rate of return is going to be zero. If the interest rates were higher, there would be a small cushion added to stock prices over the course of a year, but right now it's zero. So you can't predict forward earnings, and the risk-free rate of return is zero. So what are you left with? 50-50 bets. And when you have 50-50 bets, you have zero edge. You have zero edge, and when you have zero edge, and it's a 50-50 bet, all occurrences are completely random. This is so, so important. Because stocks are priced off of these two things, again, forward earnings, which of course we cannot predict. The second thing, the risk-free rate of return, which is zero. You're left with completely random price movements, completely random. And let's say Apple's at $150 a share. It can only go up 1 penny or down a penny. If it can only go up a penny or down a penny, so if it's at 150 and it can only go to 150.01 or 149.99, and you cannot predict forward earnings, and there is no risk-free rate of return added to the price of Apple, that means because it can only go up a penny or down a penny, it's a 50-50 bet. And in what world? Like, what are you smoking? What are you drinking? What are you on that you would put money to work on a 50-50 bet? And remember, one of the 4 things that's critical to becoming a market hero, and that's critical to making money in the stock market, is never make 50-50 bets. All bets have to be better than 50-50. So again, guys, because we cannot predict forward earnings and because the risk-free rate of return right now is zero, price movements are buying stock outright is 50-50, which means price movement is completely random. We would never make 50-50 bets. In the next video, we're going to show you exactly how we can prove that right now, everything is 50-50, and it'll be really simple. So I'll see you guys in the next video.